In the early hours of the trading day, the Indian stock market experienced an unexpected downturn. The Nifty 50 index, a benchmark of the Indian stock market, took an abrupt nosedive. It fell by a staggering 1.34%, hitting a 7-week low at 19,281 points. This drastic shift marked the largest intraday decline since March of 2023, a record that no investor wishes to see broken. The suddenness of this market drop sent ripples across the financial world, leaving both investors and analysts caught off guard. It was as if a storm had hit out of the blue, leaving everyone to scramble and seek shelter. This unexpected event left investors and analysts puzzled, wondering what could have caused such a dramatic shift. As the dust settled, analysts started to identify the factors that led to this significant market drop. At the heart of it all were the soaring yields of U.S. government bonds. As these yields rose, they put pressure on equities around the globe, including the Indian stock market. Investors began to question whether this would signal a shift from equities to bonds, creating a ripple of concern that spread across the market. But it wasn't just the surging bond yields causing unease. Growing concerns among investors about the economic impact of the ongoing pandemic also played a significant role. The fear of a national lockdown and its potential effects on businesses sent tremors through the market. Investors worried about the viability of certain sectors, and this fear only contributed to the market's drop. These factors combined to create a perfect storm that sent the market into a tailspin. The rising bond yields, coupled with the uncertainty surrounding the pandemic, created an environment of fear and doubt. These factors created an environment of uncertainty, causing investors to panic and leading to a massive sell-off in the market. In the aftermath of this significant market event, experts and analysts are left to ponder what this means for the future of the Indian stock market. The sudden downturn has undoubtedly affected investor sentiment, with some fearing a further drop in the market. However, others view this as a correction phase, a healthy sign for a market that was seen as overheated. Analysts are closely monitoring the situation, keeping an eye on the yields of U.S. government bonds and the state of the global economy. They believe that these factors will largely shape the future of the Indian stock market. Investors, on the other hand, are advised to remain cautious. While the allure of buying at a low price may be tempting, they should also be prepared for possible further drops. The market's future seems uncertain, with a multitude of possible scenarios. It could experience a swift recovery, a slow climb back, or it might continue to experience volatility. The key takeaway for investors is to stay informed, monitor developments, and make decisions based on their risk tolerance and long-term investment goals. While the market has been shaken, it remains to be seen how it will recover and what the future holds for investors in the Indian stock market.